funded by the European Research Council. So what we do in our paper in this presentation is to look at domestic political economy of the new capital requirements in the European Union, also with a reference to the Basel III agreement, which is an international agreement. So what we want to do is to explain the politics surrounding the negotiation of the new capital legislation in the European Union. And we think this topic is important for three main reasons. The first one is that the capital requirements legislation implements into binding rules, hard rules, the soft law which was agreed by the Basel Committee on Banking Supervision. The second reason is that the Basel III agreement can be regarded as one of the main responses to the crisis and also is key for financial stability. And we focus on the European Union implementation of the Basel III agreement because the European Union is the largest, well, is the second largest financial jurisdiction worldwide. And besides being a large market, also has what political scientists call regulatory capacity, as the ability to control and to implement a set of rules in the jurisdiction. And our paper starts with a puzzle. Actually, there are two interrelated puzzles. The first one is that the member states presented quite a disjointed stance on the making of capital legislation, despite more than 20-30 years of banking integration in the European Union. And the second puzzle is that the preferences which were exposed by the member states during the negotiation of Basel III and also during the negotiation of the Capital Requirements Directive do not conform to the traditional paradigms we have about regulatory preferences in the European Union. So France, Germany, which in the past were seen as market shapers, as keen to regulate financial services, were actually quite keen to have a looser interpretation of the Basel III agreement, whereas countries such as the UK, which in the past was seen as quite market-friendly, was actually keen to set in place stricter capital requirements and more restricted definition of capital, leverage, and so on. So this is the puzzle. So the second thing we do in the paper is to look at the differences between the Basel III agreement, which, as I mentioned before, is an international agreement, and the draft legislation in the European Union. And the main differences concern with the focus on core tier 1 ratio. The Capital Requirements Directive or legislation in the European Union allows silent participation and the use of hybrid capital. It does allow double counting of banking insurance subsidiaries. And also doesn't include a reference to the leverage ratio, and also includes relaxed targets for meeting liquidity ratio. So there are important differences between the Basel III agreement and the European Union proposed legislation. And I should also say that some of these topics were quite controversial in the making of the Basel III agreement. So these basically were issues which were resolved, a bit papered over in Basel III, and then were reopened in European Union negotiation. And the central argument we are making in our paper is that national preferences on Basel III and on European Union capital legislation, they basically reflect two features of national domestic political economies. The first one are institutional features of the banking system, and I want to come back to this point in my next slide. And the second one is the link between the financial system and the real economy, and in particular the impact or potential impact of capital requirements on the real economy. So in terms of institutional feature of national banking system or national financial system, we identified 3 or 4 elements as the main important. The first one is the actual capital position of banks, which is very much linked to fear about competitiveness of different banking systems. In other words, countries whose banks were already well positioned to meet the new capital requirements were quite keen to have higher, stricter capital requirements. Countries whose bank had problems in meeting higher capital requirements were keen to include longer transition period and also a looser definition of capital. The second feature is actually the bank reliance on short-term wholesale funding. Third feature is the level of securitization. And then the fourth one very much concerns the structure of the banking system and the distinctive features of the structure of the banking systems across the European Union, in particular in countries, for example, such as Germany, which have public banks, which have saving banks, or which have cooperative banks. The second point is the link between the financial system and the real economy, what we would call variety of capitalism, not so much variety of financial capitalism, and in particular the reliance of the real economy onto bank lending, and also the kind of relations which are established between banks and the real economy. Though the point we are making in the paper, and David will be making in the second part of the presentation, is that it's very important to avoid stereotypes about link between the real economy and the banking system. And now, the third thing we do in the paper is actually to look at the preferences of member states or policymakers in the member states about the main elements of Basel III and of the capital requirement legislation in the European Union. And there were four contentious points. The first one was the definition of capital, whereby what we call the Anglo-Saxon countries were keen on a restricted definition of capital, whereas Germany wanted to include reference to hybrid capital, and France actually had problems with the issue of bank assurance. Second point was the level of capital, whereby Anglo-Saxon countries were keen on higher capital requirements, whereas continental countries, France, Germany, so on, wanted a longer transition period and were less keen on a higher level of capital. The leverage ratio was proposed in the Basel Committee by the Anglo-Saxon, the UK, and the US, and was opposed by continental countries. And minimal liquidity standards were also proposed in the Basel Committee by the UK and the US, whereas continental policymakers resisted liquidity standards.
So if any of you are interested in the details, we can send you a copy of our paper. I'm not going to provide all the numbers today. We just don't have time. But the first element of our paper in terms of the data is to look at bank business models and capital position. This table or chart should show rather clearly that, that in terms of Tier 1 capital, which is banks are expected to raise Tier 1 capital reaches 6% of its of their total assets. You see that in fact Germany is in a potentially rather weak position, exposed position, because of German banks are relatively undercapitalized. And I should emphasize that the adverse position of banks has been reached already for 2012 in a range of European countries. So this is first the baseline scenario, which isn't realistic at all now. These are the estimates from the European Banking Authority, the EBA, which now undertakes European-wide stress tests. And in fact, we're looking increasingly towards the adverse situation. And Tier 1 capital amounts to principally equity. And if you look at the situation of German Landesbank, and other forms of capital are allowed under Tier 1 as well. But some of these Landesbank, these are public sector banks, some of them have been partially privatized. Many of them are in a very difficult situation, notably Nord Landesbank, LB, that's the Baden-Württemberg Landesbank as well, are in a rather exposed position. So these are banks that would potentially have to raise a lot of capital or a lot of equity in order to meet Basel III rules. And in particular, what's worrisome for German and French banks is that their capital position is rather exposed. For German banks, a large percentage of their Tier 1 capital is hybrid capital, or what are called silent participations, that is effectively loans from regional governments. And it's not just the Landesbank, the public sector banks, that receive these loans in Germany. It's also the big corporate banks, Commerzbank in particular. And German banks have a very high leverage ratio. And for some of the German Landesbanken, the leverage ratio reaches up to 88, 90%. 90. So that's effectively assets over equity or tier 1 capital. Now, for the French banks, the problem is principally about double counting. A lot of French banks run or have insurance subsidiaries, and they effectively double count the capital from their insurance subsidiaries when they determine their overall capital. In the case of French banks, on average, 28.9%, we're approaching a third of French bank capital is actually held by their insurance subsidiaries. So if double counting is banned, which is what Basel III recommended, then most French banks would come nowhere near meeting Basel III requirements. So they would have to raise a lot of capital. They raise capital, or they raise capital by issuing equity, or they seek to lower their leverage ratio by effectively divesting, or by not lending as well. So that can promote a credit crunch. Of course, British banks are in a better position because British banks were massively bailed out, and it's the nature of the bailout through capital injection that's very important with regard to British banks. But of course, some of the main British banks issued a lot of equity as well in late 2008 and early 2009, which helped their position. Another important point to note is the nature of the funding of banking systems. British banks have traditionally, particularly up until 2007, 2008, became increasingly heavily reliant on wholesale funding, and often short-term funding that is less than 1 year, and often very short-term funding of sometimes, in the case of Northern Rock, the infamous case, 3 or 4 day funding was normal. And this is funding that had to be renewed on a regular basis. But British banks have deleveraged massively. They've decreased their reliance on short-term funding. They've stopped lending, of course, to a lot of companies. And they're better prepared for Basel III rules. But nonetheless, they will still be affected, and the British economy will be affected as well. French banks will be constrained by new liquidity rules because of short-term wholesale funding. French banks rely on wholesale funding much more. These are the figures you'll see with Britain. There's a dramatic drop in the reliance on short-term funding of less than 1 year. In France, that drop has not proceeded apace. In Germany, the German banks don't rely much on wholesale funding because they have state, especially the Landesbanken, have state loans that can help them, these silent participations. So what we're going to have to see is what is likely to happen, what we see happening in France today is that France is having a bit of a credit crunch at the moment because of access issues, difficulty in accessing short-term funding on wholesale markets. Now, another important issue to raise is that this bank customer funding gap. This determines how much money a bank has to raise on wholesale markets to basically cover its lending. This is the difference between loans given to non-financial companies and deposits. So it's basically funding the loans to non-financial companies by non-traditional means, not by deposits that consumers or customers put in, but rather by the markets, through wholesale markets or through securitization. So again, in the case of Germany, we see this rapid drop in the funding gap. In the case of France, the drop remains high, and the gap remains high. In the case of Germany, it remains high as well, but that's covered to a large extent by covered bonds, which are more sort of medium to long-term funding. And the second element of our political economy analysis is the wider economic implications, the variety of financial capitalism, so to speak. And clearly, deleveraging of European banks, especially if Basel III rules are followed, and they're not going to be followed precisely, and they're being watered down in the context of the CRD4, would result in a massive deleveraging. And even in the context of this watering down process, that is allowing French banks to continue their double counting, allowing silent participations to be counted as tier 1 capital, core tier 1 capital. Despite that, there will still be a deleveraging. And of course, a deleveraging during a recession, which is what we have at the moment, could result in a massive credit crunch. Here are the figures in terms of lending. Important points to look at. For Britain, we see this dramatic drop in lending To non-financial companies, this is the credit crunch, not Britain failing to meet targets, of course, British banks failing to meet targets on lending. But in France, we don't see any drop at all. In fact, we see a rise in lending. So again, there's a potential for deleveraging there, which is quite significant. And similarly in Germany. The figures aren't precisely comparable because I can only find figures for lending to the euro area for France and Germany because these figures are provided by the European Central Bank. And this is one of many studies now. This is a study by the IMF, by 2 economists. And the principal point to take out of this complicated table is that this is the impact of banks having to raise their core tier 1 capital, that is the equity to asset ratio, by 1.3 percentage points. But in the process of doing that, there'll be a drop in lending in Germany of somewhere between 7.16 and 7.73% of lending, so a dramatic drop crunch. France will be a drop. In the UK, a less significant drop probably. The different figures represent different calculations based on different regressions. But the point is basically Germany is most exposed. Unless the Basel III rules are watered down, the German economy will suffer a massive crunch, which is not exactly what the euro area needs at this moment in time. So another crucial element of all this is the deleveraging risk for Central and Eastern European countries. Because Central and Eastern European countries have underdeveloped equity markets. They have a foreign bank presence of at least 80% for every single country, up to 100% in the case of Romania, for example. The cross-border share of bank credit for these countries is very high. In the case of, Romania, I just contradict myself, 97% of bank assets. But if you go to the Baltic states, it approaches 100%. But of those 97% of bank assets, 53% of bank credits are cross-border. So that you can imagine, therefore, about half of Romanian lending is exposed to the deleveraging process in banks in Western Europe. In the case of Romania, it's Italian banks and other banks. So our general conclusions, because I'm finishing, you'll be happy to hear, Sylvia, are that national policymakers are more likely to support higher capital requirements and a tighter definition of capital if their banks and banking systems enjoyed higher existing Tier 1 capital, lower leverage ratios, higher comparative reliance on domestic banks on equity financing, diminished reliance on short-term wholesale financing. And so it's not surprising that the British and the Swedish are pushing most vigorously for more higher capital requirements for their domestic banks and being allowed to push the maximum allowed to go beyond the European level set, which is a major debate in the European context. And of course, if their non-financial companies are less reliant on non-bank credit as well, and can access equity markets, which of course is less the case in Central and Eastern Europe. So institutional features of the domestic banking sector and the national variety of financial capitalism result in divergent European preferences on the Capital Requirements Directive. EU members' preferences reflect not only banking competitiveness concerns, but they also reflect deeper structural features of national financial systems and national varieties of capitalism. And the lesson from this presentation is to think about how difficult it is to construct effective rules at the EU level to deal with the issue of stabilizing banks. Because we all want stable banks, but none of us want a credit crunch. So there's a lot the European Commission is in a very difficult position in trying to manage conflicting interests. The German Banking Federation called for a 30-year grandfathering clause on Basel III rules because they recognized the impact that these rules would have upon the domestic banking system. So it's very difficult to construct effective European regulation in this kind of context. Thanks very much.
So thank you very much. So you've heard the academic viewpoint and you've heard the industry viewpoint, and now it's time for the regulator's viewpoint. I would just say there are basically basically two ways you can recognize the regulator in the room. The first one is he's wearing a tie, and the second one is he doesn't have a PowerPoint presentation because he spends his life in wall-to-wall meetings and doesn't have time to prepare a PowerPoint presentation. But I will simply, out of my head in a way which is hopefully as structured as possible, give you an outline of the point of view from the European Commission. I mean, I work for Michel Barnier, and I'm here in working time, not in my own personal time, so I will be the mouth of Michel Barnier in this room. It would be easy for me to spend 17 or 18 minutes simply reacting to all of the points made in the previous two presentations, but that would be very defensive and reactive, and I'm not going to do that. Simply, perhaps before I start on my presentation, a couple of remarks on the first presentation with regard to the implementation of the Basel III agreement in the EU. I do always find it ironic that people often, in a very detailed way, go through our 1,000 pages of proposal for the Capital Requirements Directive and Regulation to look at, find alleged inconsistencies with the Basel Agreement, when, of course, our friends and counterparts on the other side of the Atlantic have not even implemented Basel II yet. So the moral seems to be that if you want to escape detailed criticism, the best thing is to do nothing. But we don't do nothing because we're more responsible than that, and we're very happy to take the criticism that goes with it. And I did actually bring with me a very, very detailed paper rebutting point by point the points made by David and Lucia in their presentation. I happened to show it to David, and he put it straight in his pocket, so I haven't got it anymore. so I can't actually rebut those points detail by detail unless he gives me the paper back. But no, what I'm going to talk about today is our whole regulatory agenda, what we have achieved so far, what's currently ongoing, and what is in the future. And what is in the future is obviously the most interesting part, and comes under the slogan of banking union, which is the thing that everybody is talking about at the moment. But you have to stay awake till the end of the presentation to hear a little bit about that. So we have gone through a number of years of intensive regulation. The number of pieces of legislation, looking only at what we call level 1 legislation, the legislation which is adopted by the Council and the Parliament, we have had more than 30 pieces of legislation over the last few years, all of them, almost all of them, in reaction to the 2007-2008 banking crisis with its subprime origins. And the Capital Requirements Directive and Regulation that you heard about is one of them. The Alternative Investment Fund Managers Directive that you heard about is another one. The Solvency II that was mentioned for insurance companies is another one. It would be boring to list them all. We have regulated credit rating agencies for the first time. We have proposals which are not yet adopted, which are going through the legislative procedure, like the revised MiFID directive on trading venues and capital markets. We had a very big success earlier this year when the Council and Parliament agreed our proposed regulation on OTC derivatives, over-the-counter derivatives, obliging central clearing of such derivatives. This is a G20 commitment. So we have a lot of success stories. I mean, in our terms, success stories means more regulation. maybe that's not what the industry would consider to be a success story. So we are well on track to meet our G20 commitments. The G20 is playing a huge role in the reaction to the financial crisis. There are a number of key commitments which all the G20 members have signed up to. Implementing Basel III is one. The obligation for central clearing of OTC derivatives is another. Binding rules on remuneration and bonuses in the banking sector is another. And we feel that in the EU we are in the lead in the implementation of these commitments, and perhaps our counterparts on the other side of the Atlantic are lagging behind in some respect. Now, there's one particular aspect of our latest phase of financial regulation that I want to dwell on for a little moment, because it is something which is perhaps a little bit controversial, in particular in the financial sector, and this is what we refer to under the term of the single rule book. Now, what is a single rule book? A single rule book means that as far as financial regulation is concerned, we will move more and more, wherever it's possible, to firstly directly applicable rules at EU level, and this means rules basically enacted in the form of regulations and not directives, which can be transposed into national law with variations and divergences. It also means that we are moving away from the historic approach for single market legislation, which was minimum harmonization and allowing what we call gold plating in the member states. This means the member states can impose extra requirements that they wish, and we are moving more and more towards maximum harmonization. And now this is an approach which was validated by a meeting of the European Council in 2009. All of the member states signed up to the objective of the single rule book, though whether the actual detailed meaning of a single rule book was understood in the same way by all of the member states around the table is not clear. But from the point of view of the European Commission, it means that we want a harmonized set of rules, including in the details, for the financial sector around Europe. So the classic example that I often give is that at the moment, before CRDIV enters into force, there are 27 different definitions of own funds for banks in the European Union, and this is something which we do not wish to continue. And there are many other such examples on detailed level of such divergences. So that's one point. Another point, a very major success that we have achieved so far, which is not actually regulatory, which I consider to be a great success also because I was involved in it myself, is the creation of the new supervisory framework for the European Union. Now, it was mentioned in the first presentation that the European Banking Authority is responsible for stress testing of banks throughout Europe. Now, what is the European Banking Authority? It's a body which has only existed since the 1st of January 2011. It didn't exist before. There were some committees with no particular binding powers. But since the 1st of January 2011, we have created a European Banking Authority, which happens to be in London, a European Insurance and Occupational Pensions Authority, which is in Frankfurt, and a European Securities and Markets Authority, which is in Paris. And the ESMA, the European Securities and Markets Authority, is also, as it happens, the supervisor, the only supervisor in the whole of the European Union for credit rating agencies. and soon also trade repositories, which is a very specific function for securities transactions. Now, this is a huge precedent. Credit rating agencies are one particular sector. There are only about 20 of them active in the European Union, of which there are the big three and some many smaller ones. So it was quite rational to have them supervised at European level because their activity is pan-European in its very nature. But this is a very important precedent which could be the basis for future building, because it has now been accepted by all of the member states that having EU bodies, not the European Commission, but other EU bodies acting as supervisor for some kind of financial institutions is something which is possible, and it already happens. It's already in place today. So these are really huge changes that have been made already in a very short space of time. However, we have a number of things which are still on the go. The most important gap that remains for us as far as meeting our G20 commitments is concerned is to introduce a framework for bank resolution. Resolution that is of failing banks. This is something which G20 members have committed to do. The European Commission has been working on a proposal for bank resolution for quite some time now, and it has been delayed a few times due to concerns about getting the timing right, about getting the details right, etc., etc. But it is very important to bring it out, and I can tell you that this proposal is going to be out within a matter of days. Hopefully within the next week or two, the Commission is going to adopt its proposal for legislation on bank resolution. And this is important because banks, it must be possible for a bank to fail. If a bank cannot fail, even a small or medium-sized bank, such as Northern Rock, cannot be allowed to fail without fear of systemic consequences and shockwaves throughout the entire sector. This means that banks are somehow different from any other kind of company in a capitalist economy. Any other kind of company can fail. It's very traumatic for those directly involved, but it doesn't have systemic consequences. So we need to make sure that banks can fail in a structured and orderly way without knock-on consequences. Now, the one thing which has been obviously very controversial in our bank resolution proposal, which was the subject of a discussion paper a few weeks ago, is what we call the bail-in aspect. Now, bail-in is, of course, the opposite of bail-out. Bail-out means that the taxpayer pays for resolving a failing institution, and bail-in basically means that some or all of the bondholders must take a haircut. Now, our internal calculations show that in all of the recent cases of banking failure in the European Union, a haircut of around 20% for bondholders would have been sufficient to eliminate completely the need for taxpayer intervention. And that includes RBS, that includes all the Irish banks. So it does not mean that the bondholders would have been wiped out. It would have been only a 20% haircut. Now, of course, the banks are very concerned about this because it will clearly have some consequences for the cost of funding of banks. And it's already quite difficult for banks to get funding, which is why they are relying so strongly on the European Central Bank. But we believe that the markets have in any case priced our proposal into the cost of bank funding already. So I can't tell you the details, the exact modalities, what will be the nature of the bail-in, because the proposal is under wraps, but the proposal will come out within a few days, and it will include strong provisions on bail-in. But it's important for me to emphasize that the purpose of bail-in is also different from the purpose of bail-out. The purpose of bail-out is to basically save a failing institution. The purpose of our bank resolution proposal, of course, there are many elements in there for upstream intervention in order to try to prevent an institution from failing. But if it does fail, the purpose of bail-in and the other provisions in our proposal is to allow structured and orderly winding up of a failed institution, for example, via a bridge bank, etc. It's not to enable the institution to continue trading in its existing form. So it is not to save the institution, it's to allow an orderly wind-up. That's very important. The second ongoing initiative that I want to mention is shadow banking, also known as the parallel banking sector. Shadow banking includes all of those aspects which are mainly off-balance sheet for banks, but which carry out maturity transformation, which is the core of a banking system, but which escape from banking regulations such as capital requirements. We have things such as money market funds. Money market funds are very big in the USA, also quite big in France, not quite so big in this country, but they are often treated as basically quasi-bank accounts, because they have rather stable asset values. Some of them offer constant net asset value, but they don't benefit from any kind of deposit guarantee. Capital requirements do not apply. So the question is, should we have stronger regulation there? Repo transactions are very important in maturity transformation and often escape banking regulation. And there are other kind of special banking entities as well, and non-bank finance companies, which are all kind of out there in the ether and which often are constructed in such a way as to fall through the holes in the net of regulation. Now, and there are many ongoing work streams on this in the Financial Stability Board, in IOSCO. We are following those. We had a very major conference on shadow banking on April 27th. And we are committed to come forward with legislation on shadow banking around the end of the year. What will be in it is still not determined because there is a consultation process going on. But shadow banking is a very important area that we are currently working on. The third area that we are currently working on that I want to mention, now this is something which has already been mentioned, and this is what I call squaring the circle between stability and growth. We try to use regulation to ensure stability of the financial sector, but we also need growth. We need to ensure that the banking sector the financial sector in general can continue to supply long-term financing to the economy. Now, we are going to come out with a green paper or communication around November time, something like that, with some ideas as to how we can use regulation to stimulate growth. A couple of examples were mentioned already by Owen. There was the proposal for venture capital, socially responsible investment funds. We have some proposals to help SMEs get access to financial markets, but we need to do more. And the key issue there is, what do we do with the risk weightings? Risk weightings for bank investment in SMEs. Do we reduce them to stimulate banks to invest more in SMEs? But that could be risky. So that's an important thing. Okay, now the final thing that I wanted to mention is what's coming up in the future. Now, what's very interesting is that our whole new supervisory framework that I mentioned before has to be evaluated before the end of 2013, and the European Parliament put some text into the regulations creating these institutions, saying that the evaluation must consider the feasibility of direct EU-level supervision of cross-border financial institutions, and also progress towards a pan-European deposit guarantee scheme and pan-European resolution arrangements. Now, this is all precisely what some people have recently been talking about and calling for under the heading of banking union. Some people have been calling for EU banking union. There was a speech by Adair Turner of the FSA, 27th of April, the same day as our shadow banking conference. Financial risk and regulation, do we need more Europe or less? Well, his conclusion is that we need much more Europe, but for the Eurozone only. That's a very predictable conclusion. But the issue for us is Well, first, the question, do we propose EU-level supervision of cross-border banks? We haven't proposed that yet. We have EU-level supervision of non-banking institutions such as credit rating agencies, but would we propose EU-level supervision of cross-border banks? Would we propose an EU-level deposit guarantee scheme? Would we propose an EU-level resolution fund? Now, what we have proposed so far for deposit guarantee schemes and resolution, and what we will propose in a few days on resolution funds, is a network of 27 nationally based funds, deposit guarantee funds or resolution funds, or both combined, but with interlinkages so that they can mutually assist each other in case they can't meet their obligations. But what we have not proposed so far is an EU-level fund. For either thing. We have the European Stability Mechanism, but that's not what it was really designed for. Some people have said we should use the European Stability Mechanism for deposit guarantees or assisting banks. That was not the original purpose. So we need to decide, first of all, do we propose this package? Because it has to be a package. It's either nothing or everything. EU-level supervision of banks, presumably by the European Banking Authority, EU-level deposit guarantee fund, and EU-level resolution fund. It has to be all those or nothing. So do we propose that or not? And if we do so, do we do that for the EU27 or the EU17, the Eurozone members only? Commissioner Barnier made a statement on Friday saying that we are in favor of the banking union. The details remain to be decided, and that we remain committed to proposing legislation for the EU27. If legislation proposed for the EU27 doesn't get through, then we can consider what's called enhanced cooperation. A number of member states can go ahead together. We did this for patents, for example, outside the financial services field, but we don't just propose things straight away for the Eurozone only. We propose them for the 27. The financial transactions tax is an example. We propose it for the 27. If it doesn't fly at the level of the 27, then we might reflect on going ahead for the Eurozone only under enhanced cooperation. So we are in favor of banking union. The details remain to be put on the bones. Of course, we remain committed to our current proposals, first of all, which are the deposit guarantees, resolution funds, 27 national funds with mutual assistance between them, but we may come forward with proposals later at EU level. But it will be, in the first place, EU27. We see how that flies before we consider any kind of proposal for a more limited number of member states. And that's basically all I can say to you at the moment. These are very, very, very interesting times because, of course, they are crisis times. Crisis times are always the most interesting times, and the times when regulators are very active and very stimulated, which we are at the moment. Thank you very much.
Well, thanks very much indeed to David for inviting me. I'd like to just really offer a few thoughts very much from an industry perspective. I'm not an academic, so I make no pretense of the kind of rigour you will have heard from other speakers. Let me begin by very briefly introducing our organisation and explaining who I am. So we're a trade body, basically. We represent Scotland's financial services industry. We have done for the last 25 years or so. We were set up when Big Bang happened in the City of London, very much as a response from the Scottish financial community, which has, a 300-year history. We've been an international centre for many years, and we were set up as a response to Big Bang in the city and the implications of that. We're a membership organisation, so we're private. Our members are people like Royal Bank of Scotland, Standard Life, Aberdeen Asset Management, many familiar names, JP Morgan, Inward Investors, all kinds of financial services companies. We have members throughout Scotland, and our objectives are, as they are there, to promote Scotland as a financial centre, but also to lobby and influence regulators, and it's really that I want to speak about today. We work very closely with authorities in the UK, in Scotland, but also in the EU, and it's an important feature of Scotland as a financial centre that asset management, fund management is probably, I would say this, some people may disagree, but that probably is sort of the jewel in the crown, if you like. That is the thing we are internationally recognised for Scotland is the 4th largest centre for assets, by assets under management, we're the 4th largest centre in the EU after UK, France and Germany. So we're a very significant centre. The reason I mention that is that our engagement on EU regulation has focused, generally speaking, on asset management, and I'll say a little bit about the reasons for that. This is not a presentation that contains any figures. It's entirely our views as formed from our engagement with the EU authorities. I'm not going to quote any particular company. I'm going to keep my comments quite generic, but they are based on the experience of a number of companies in recent years. So I thought I'd just begin by running through some trends as they seem to us from our particular industry perspective. The first, slightly obvious point perhaps, but certainly the invocation of the G20 authority for an awful lot of regulation as determined from Brussels is a very, very prominent feature of our conversations. It often comes back to a reference to the G20 and the discussions, and particularly the G20's recommendation or suggestion that all areas of financial services should be regulated. A second trend that's probably, again, painfully obvious in many ways, but I think has had really quite profound repercussions for us here in Scotland is the change in the position of the UK as arguably in the years preceding 2008, a rather swaggering, overly self-confident financial centre within the EU. You know, I'm obviously painting a caricature, but the kind of view that, well, you know, we need to talk to New York, we probably need to talk to Tokyo, and yeah, you know, we also need to go to Brussels occasionally. You know, that's not actually a million miles from the truth in terms of the attitudes that prevailed during what we can now see as the bubble years. And I think that dynamic has changed enormously, and I think our industry here in the UK is still working through the implications of that. It's very striking when you look at the lobbying or influencing operations or just the ways of engaging in Brussels, that companies like Citi or JP Morgan have very, very well developed teams, these big American banks who see the EU as another jurisdiction that they need to engage with. And then you contrast that with how the UK has approached that sort of activity. Now you might say that's because we're a member state and that is a big difference, but nonetheless I think that there is a big change coming through our industry, and it follows on from this change in the position of the UK. Another trend we think is observable is that the sort of discretion that's given to level 2 discussions appears to some extent to have been eroded by a political desire to get more written into the level 1. And from our point of view as an industry, I think, and I'm not just saying this because Steve's following me, we think that sort of underplays the skills and capacities of the Commission to work through at level 2 and actually make things work. And we think some of the recent, and recently of course we've seen a bit of controversy around AIFM, the Alternative Investment Fund Managers Directive, and accusations that decisions taken at level 1 have somehow not been stuck to as we go through the level 2 process. So that's been, I think, a trend. And similar but different is there seems to be less member state discretion on a lot of regulatory change now. The idea that, for example, here in the UK, our regulatory authority is the Financial Services Authority, soon to become reformed and become part of a larger Bank of England, and the idea that they really cut and paste from regulation coming from Brussels is, I think, again, an observable trend. And finally, on this list, and reflecting perhaps an asset management view, a tendency, understandable, I mean, given the kind of complexities that David's been outlining, to adopt a one-size-fits-all approach. And in the Capital Requirements Directive, for example, you know, quite a strongly held view amongst asset managers that they're sort of being treated like banks, but actually they're agency businesses, they don't really have the same sort of capital requirements as banks. So that's just some trends. Before we were chatting beforehand, we were saying how unhelpful it is to talk in terms of Anglo-Saxon and other attitudes, hence my speech marks here, because these are obviously, again, caricatures. But I think it's been our experience that there are some quite profound philosophical differences, if you like, between the way we in financial services in the UK see the business of investing and managing risk, and a view that I don't attribute to any particular member state at all, or indeed to any political trend within the European Parliament in particular, but a feeling that there's an alternative view to the kind of very the Anglo-Saxon view, which is very focused on monetary value in investing, and particular, I suppose, as we might see it, as people, as businesses operating in the UK, a safety-first approach is one way in which people describe it, a view that really investors need almost to be protected from themselves. And, I put there, I won't run through all of these because obviously I know time is pressing, but, some examples of how these different ideas play out. In the case of the Alternative Investment Fund Managers Directive, which I saw in the FT yesterday, it was written up very much as a kind of watershed in a way, and almost taking our industry here by surprise. I actually think that's a fair comment. I think the AIFM really did unfold very quickly. I mean, I'm sure in other talks people have rehearsed that process where you had really a decision, a politically driven decision, and again understandable in the circumstances, to move very, very quickly. And that did mean that the usual consultation mechanisms weren't applied, and things really did hit the ground running. And for our industry, that was a bit of a, wake-up call is probably the way to put it. And particularly for our fund managers here in Edinburgh, just to sort of bring it back to the local, I think it was, a really sort of stiff lesson in just how immediately significant and important discussions going on in Brussels and indeed in other member state capitals were to the day-to-day business that we conduct here. Solvency II, again, I mention this without going into the detail simply because it also perhaps illustrates different views about risk and how you should assess capital and how very large insurance and pension funds should manage those risks. And I also we've recently been very, enjoyed some good conversations with the Commission, and recently proposals coming forward, almost, if you like, carve out separate freestanding proposals around venture capital and social investing. And, it raises the question, I think, as to whether philosophically we see sort of good forms of investing which we need to treat some way, and then another form of investing which is kind of bad because it's a bit sort of, red in tooth and claw and it's all about making money. And I think that's a philosophical difference, which it's interesting to see illustrated by those initiatives. And finally, financial transaction tax. No discussion at the moment in our industry about developments in the EU would be complete without a reference to the financial transaction tax. It's not really an Anglo-Saxon stroke continental thing, but as everyone probably will know, that the rationale behind the Tobin idea of the tax was actually to discourage a certain type of investing behaviour. I'm not sure if that was the original rationale behind the financial transaction tax as proposed and as refined through various political discussions at the EU level, but it certainly seems now to be primarily a revenue raiser rather than a tool for changing the way in which investing happens in the economy. So I suppose what I'm highlighting there is almost an uncertainty about the rationale for that kind of far-reaching policy. I just wanted to say a few words, again, just sticking with our impressions as much as anything. I've already touched on the changes to the UK influence. That quote there, that we're just one among 27 or so, that's from the FSA, who have changed, in their view, from being highly influential, almost the leading regulator as they probably saw it in that time when we had our inflated beliefs about the value of the City of London. That has unquestionably changed. And, just as an illustration of the way in which the industry has to adapt to this changing political climate, it feels to us as if there is a greater appetite on the part of politicians in the European Parliament in particular to hear from Scotland, simply because there is an understandable mistrust of what may well be perceived as this big dominant machine called the City of London, which arguably, or in the eyes of some, contributed in a large part to the overall financial crisis. So what does that mean in practice? It means that we need to ensure that we use our opportunities as a Scottish voice, but to be honest, saying precisely the same things, because we're one jurisdiction within the UK, saying precisely the same things as our London colleagues, but if we find that there's more of a more receptive attitude amongst legislators in the European Parliament, then we start to take advantage of that. Eurozone banking reform clearly has the potential to change the landscape of political decision-making enormously if it does follow through in the way that's being mooted at the moment, where you start to have a much more Eurozone-specific banking regulation. Clearly that has major implications for the UK, not least in how we participate in that, and it could be part, unfortunately, of a longer-term trend of the UK becoming isolated from political decision-making. And finally on this, I mean, this is, again, you know, not saying anything at all new, but to my mind is a very long-term and difficult issue for our industry. To say the industry is distrusted by policymakers is an understatement, I think. And that reflects, I understand that reflects public views. I mean, our own sister organisation in London, a much bigger organisation than we are actually, but they invested a lot of money and time in doing some really thorough work on how the UK public perceived our industry, and it was unbelievably negative. I mean, unbelievably negative. Now, nobody's ever loved bankers, that's probably a fair comment, but it really is a fundamental problem now, the absence of trust between our industry and our customers. And I think there's a lot more work to do to regain that trust. Of course, in the regulatory space, that means that a lot of what we say is so heavily discounted that it doesn't win through. And I'll perhaps come back to that point in my final slide. Yeah, and I should say on that point about the work that's been done on trust. I don't think that's a UK thing. Our kind of counterparts in other financial centres in Europe, I think, would very strongly agree with that. So, some final conclusions, very, very quickly. The volume of regulatory change, we all know, is huge. This is having a real impact not only on companies, but also on customers ultimately, because there's a huge increase in risk and compliance costs, and that's coming through not only in terms of workload for companies, but also education providers and others being expected to meet that challenge. Fragmentation, I think, again, an observable trend. It is sadly not the case, despite what I said about the G20, that there is an enormous amount of international coordination, and I think that is creating multiple burdens. And finally, my final point, I suppose, customer focus. We are often criticised in an industry for not having focus on the customer, but I think an awful lot of regulation could helpfully consider, really as its starting point, what is the impact here on the customer. And I mean by that the saver, the pension holder, and it's striking as going back to the AIFM directive and the lobbying that went on around that. It was only really when the Dutch pension funds weighed in with their observations that actually some of this stuff is going to cause the people who actually invest in our pension funds to lose money. So I suppose my question I leave you with is, how much is regulation really focused on the customer? Thank you.
I had a question on Lucia and David's paper, but also for Owen. There seems to be quite an interesting mix of absolute and relative position between the three countries and how that plays out in their perceptions of their interests. The UK is concerned about its relative position, but doesn't care about its absolute position, as in the reduction of lending, having to keep higher capital, etc. The Germans quite clearly care relative and absolutely. The French choose either to care absolutely or they care more about their relative position to the UK than they do about their relative advantage to Germany. So I was wondering if you could say a little bit about sort of disentangling the absolute and the relative. And I wondered in the same regard from Owen if that is actually the relative attitude is how you're members see their interests? So are you lobbying saying, it doesn't matter if you screw me as long as you screw the French more? Or are you actually concerned with your absolute ability to make profits or have low capital or pay better or whatever?
Shall I go first?
Yeah.
I think on the relative point, I think it's fair to say that while the EU is a really important market for our member companies in all sectors, in judging relativity, people don't, probably the most relative thing they're interested in is actually Asia, emerging markets, US to some extent. I suppose an example of that, I was at a discussion this week, and there was a great deal of concern being expressed about the cumulative impact of capital requirements, not only Basel, but the general trend towards making infrastructure investment and the necessary bank support for that in emerging markets, particularly in Asia, was being choked off almost entirely. Now, some banks can still operate in that space, Standard Chartered, for example, and others, but many of those banks which have traditionally done an awful lot of that, and I think some French banks included in that, that they simply aren't doing that anymore. So that's, I suppose, an example of the sort of relative impact in markets outside the EU that that our members take a close interest in. Now, I'm not going to sort of, self-importantly claim that, the City of London or the UK is more international in its outlook than other financial centres in the EU. That would be quite wrong. But I think proportionately, I think the evidence is that some 80% of activity in the City of London is international, and I think there is perhaps a slightly different perspective. In terms of relativity with other member states and so on, I mean, you hear a lot of chat about, how, I don't know, I mean, Steve will know much more than I do, but there is chat that, the rules are being, designed to favour one member state or one financial centre over another. Yeah, I think some people do harbour those views, but overall, I suppose my answer is that the outlook in terms of relativities is conditioned almost as much, if in some cases not more, by relativities with markets outside the EU as well as within it.
More broadly speaking, I would focus on the absolute rather than the relative. In the case of the UK, we see what George Osborne has referred to as the British dilemma. The British government wants to reduce the British taxpayers' liability with regard to banks. And this explains to a large extent why the British government moved relatively quickly, and prior to 2010 moved quite quickly to try to enforce tighter regulation on banks, starting with liquidity rules in 2009. Likewise with France, this concern about double counting, it is because of the structure of the system, and this applies not just to France, but also to Spain, Austria, and a few other European countries, whereby banks provide insurance services. And to expect the French government, the French banking system, to meet the requirement on a ban on double counting, which I don't think is a technicality, which Steve might suggest, but it's actually a very central issue to how the French count or allow their banks to count their capital. It would have, if double counting rules were applied in France, there would be a significant credit crunch. Similarly for Germany, there's the relative issue, it's an absolute issue. The German banking system and the German financial system, the German economy, relies proportionately more on bank credit than equity. A lot of the banks they don't raise capital, these banks. A lot of bank lending comes from, they come from cooperative banks, savings banks, or from the Landesbanken. they don't have tier one equity, tier one capital. Core tier one capital is defined under Basel III. So to impose Basel III rules on the German banking system would be devastating. And that explains why there's a 30-year grandfathering clause, or the 30-year grandfathering clause was demanded by a banking federation representing not just the cooperative banks, saving banks, but also the big commercial banks. So it's about a banking system and the interrelationship of that banking system and the wider economy. Now there is a relative angle, and there's a competitiveness dimension, and there is a dimension of regulatory arbitrage, and we wouldn't deny that. Clearly, the capital position of banks at the moment is an important dimension of their competitiveness. It's an important dimension of their attractiveness to international investors. So when British banks try to raise money on financial markets, or want to issue equity, now that one of the points that they make today, first points they make, is that we have a sound, very strong capital position, particularly in comparison to a lot of our European rivals. And I think that relative dimension there also helps to explain, in part, why the British government is frustrated or opposed to this idea of a maximum harmonization, and would prefer, it's not just the British, but it's the Swedish, and I think even the Spanish, would prefer to allow, to be able to force their home banks to go a bit further. Having said that, the British Banking Association is not pushing for higher capital requirements because they don't see an intrinsic interest. That's coming from the British government. And Lucia and I have spoken to quite a few people about this issue. So the relative aspect is there. This issue of regulatory arbitrage is present. It helps define national positions, but I think the absolute is much more important in this context.
I'm going to take the chair's prerogative for a second and ask a follow-up. Absolute and relative is a tricky thing, because any central banker will tell you that you can usually argue both sides of the liquidity solvency line. So my question is, to what extent, to all three of you, to what extent, from an absolute perspective, does, for example, the impact on all of Europe of a rule imposition that would cause a credit crunch in Germany influence the European-wide consideration?
We are in the European Commission. We are very intensely aware of the risks of inappropriate deleveraging and the possible consequences in terms of credit crunch. We've made a number of interventions to try to avert that. I mean, I can give a few examples. It happened a while back that the Austrian financial supervisor, it very informally, not in any kind of written instruction, but recommended its banks to reduce their exposure to member states outside their home country. And of course, the Austrian banks, such as Raiffeisen, are among the banks which are the most active in Central and Eastern European countries. And it was absolutely true what David was saying about the Central and Eastern European countries being highly exposed to risks of deleveraging. And we intervened very quickly behind the scenes to indicate to the Austrian supervisor that if that very informal message ever became formalized, it would immediately be the subject of infringement proceedings as being incompatible with the internal market. So that's one example of how we intervened. Another thing concerns the current ongoing recapitalization exercise of banks in the EU, which is being coordinated by the European Banking Authority. This is not the same thing as stress testing. This is something which was decided by the European Council last year, that banks should already recapitalize. Basically, it's sort of a partial early application of Basel III, but not based on any kind of legislative obligation. Now, the European Banking Authority is overseeing this recapitalization. There aren't any UK banks concerned by this, but there are a number in other member states. And in particular, it reviewed the recapitalization plans to make sure that the recapitalization was not achieved principally by deleveraging. The favored way of achieving the recapitalization is retained earnings, retained income, non-payment of dividends, etc. Maybe some selective divestment of non-central assets is also acceptable, but generalized deleveraging is not acceptable as a means to achieve the recapitalization. Again, we are constantly looking for further ideas, and as I said, there's going to be a green paper in the autumn about how we can favor financial sector funding of the real economy. One important means is disintermediation, to rely less on banks. So there are some indications coming in particular from Germany that during the last few years of crisis, small and medium-sized companies have been accessing the bond markets directly and not so much going via the banking sector. So if we can look at possible disintermediation and stimulating venture capital, we have a legislative proposal to try to make EU-level venture capital activities a bit more easier. It's not a magic wand. It's not a magic wand which is going to wave away all the economic difficulties, but it's a brick in the wall. So we're looking at all these possibilities.
I suppose my answer would just be a sort of pragmatic one. I mean, I think that kind of move would have real life impacts, wouldn't it, on real people and businesses. And I suppose in a certain sense, looking at the problems facing the Eurozone at the moment, it's quite a theoretical question, but I think there's a real question behind it about democratic legitimacy, actually, and the legitimacy of following that kind of absolute requirement and driving it through right across the Union. As I say, I mean, in a sense, it's a theoretical question because the problems, how the problems are resolved within the Eurozone as a single currency area are so momentous at the moment. But I suppose, as I say, I think from a kind of, if you were looking at it from a sort of, sort of bond investor type of perspective or anything like that, you would, I think, firstly question whether it was achievable in a political sense within the Union.
The problem is, this goes back to Steve's point about the Austrian, was it the Austrian head of the Austrian Central Bank? So?
No, financial supervisor.
Financial supervisor, thank you. Important difference. His point, the problem is that banks are, in a context of deleveraging, which whether we want them to do this or not is happening, banks are more likely to retreat to home markets. And and particularly in the current context, because of course many of these banks rely on funding from taxpayers. And that will mean that whatever the European Commission says about the internal market, the reality is that lending is more likely to decline, be withdrawn from countries beyond the home market. And that will almost certainly be Central and Eastern Europe. So it creates strain for the internal market. But the political dimension in this context, particularly during a period of recession, will encourage that policy on the part of banks.
Yeah, and another thing which puts strain on the internal market is what the UK Financial Services Authority is doing a little bit behind the scenes, which is putting great pressure on foreign branches to change into subsidiaries. I mean, our internal market in financial services is founded on the ability to be active in any market via a branch with home country supervision. So if you insist on formation of subsidiaries, then you have no home country supervision anymore. And this is something which is particularly an issue in the UK. The Financial Services Authority doesn't really like branches.
And just one, this doesn't quite address your question, but it stems from something that Steve mentioned about German companies, small and medium-sized countries, even turning to the bond markets. Emil Polis, one of Steve's bosses, was quite high up, and a friend, high up in DG Internal Market, was here about a month ago, and his line was, and I assume this is very much the Commission's line, is that the development of equity markets is our future, and that the European Commission, in coordination with national authorities, is to actively promote the development of equity and also bond markets, particularly in Central and Eastern Europe. That can probably help the situation, perhaps potentially in the medium to long term, but in the short term, it's not a solution to dealing with a credit crunch in Central and Eastern Europe.
Thank you. Other questions from the audience?
This last argument by Steve, or the insight that he has given us about the FSA being very concerned about branches being controlled via home supervision, raises a bigger question on which I would like to hear what both the research from Lucia and David, the perspective of the industry, and your own thinking is. I mean, one lesson you could draw from this financial crisis is actually that we have given the support mechanisms when things go wrong, the externalities, spillovers that come from different home supervision, and I'm afraid the Brits have to look a little bit at themselves and say, what have we done, and we do that to the rest of the world, so it's not just your own business. But that we have therefore almost too much integration, given how little support we have now, say for the new architecture of financial supervision. There is no money behind it, and it will be always the ECB that has to step in, which is already overburdened with the sovereign debt crisis. So a question would arise, is perhaps less integration in this area the only way, given the degree of integration, the fiscal backing for financial supervision that we have reached?
If you ask an official of the European Commission, if you say to an official of the European Commission, the current situation is untenable, we need either less Europe or more Europe, I think you know what answer you're going to get.
But going back to Steve worked on the La Rosière report, and he'll know that that issue of financial backing was a non-starter. It wasn't included in the report. It wasn't, and it's not. And many countries hid behind the British opposition to that financial backing. But the reality is it's highly unlikely that the French or even the Germans would have supported that. It's a non-starter. But it shows perhaps not the emptiness of the concept of banking union, but the weaknesses in the construction of banking union as currently conceived.
I could only, listening to conversations in the industry, I think there is a concern about the sort of balkanization of banking and the impact that would, in terms of regulation and capital and so on. As I say, I come back to the impact of that on emerging markets and those parts of the world where we expect to see we hope to see some economic growth that can continue to support world economic growth. And I think there is a concern that the capacity of the capital markets to drive that sort of development will be quite heavily constrained because of this. Sorry, I'm using the word balkanization because it's the word that was used when I was listening to it, but a sort of a fragmentation, if you like, and I think that's a very big question, and one I'm sure that regulators and others are keeping in mind.
I would just add slightly less flippantly than my first intervention. We do fully accept that EU level supervision is a non-starter without funding to back it up. And this is what we call the fiscal safeguard issue. I mean, the ultimate power of a supervisor is to require a recapitalization of an institution, but then somebody has to pay for the recapitalization if the markets are not willing, which means public money as a last resort. And where will it come from? And of course, the current Currently, the European supervisory authorities have an article in their founding statute saying that they may not take any kind of action or decision which would lead to fiscal consequences for the member states, which is very, very clear. And if they were to become direct supervisors, that would have to be changed. But I mean, David said that even France would not accept that. Well, I think France, with its new president, might have a more flexible approach. I mean, in the EU, there are no bad ideas. There are good ideas whose time has not yet come.
Other questions from the audience?
Yeah, the first speaker mentioned the role of the G20 and in some sense saying much of this is outside European control. And indeed one can see more or less the whole crisis, so-called, in Europe as being something that has risen by activities outside the European Union, although possibly by a international banking group that controls many other banks worldwide. What would be the response to how to influence this international situation, of which in many ways we are a tiny part?
Okay. I think the European Union has become, in particular after the financial crisis, a slightly more important player than it was in the past in international regulatory fora, both in the G20 and also, for example, in the Basel Committee on the International Association of Insurance Supervisors. So it seems to me that the European Union has increased its voice, and of course the European Union is more powerful whenever it's able to present a united position, or at least a coherent position in international fora. And this was clear in some of the G20 meeting, and the opposite was also clear in the case of the Basel Committee, when the European Union, at least the European Union countries representing the committee, presented a very diversified, a very disjointed position, so we could not speak of a European Union position in Basel despite 20 years of financial integration. And while I was doing research on the Basel Committee, this was quite surprising to me. The Commission was there, and I was told that Mario Nava did a very good job in trying to coordinate the European position, but was not entirely successful in doing so. The European Central Bank was also present as an observer, but then there was not a European Union position there. So it seems to be that very much depends on the international fora we are talking about, and also on the specific issues at stake.
I suppose I would just I think when Barack Obama was first elected, that there was probably an opportunity there to really make a big, step change in terms of international collaboration. I'm not sure. I think that's fragmented quite a bit in the years since. I mean, Steve mentioned, American approaches to the Basel changes. I suppose, it's probably common sort of water cooler chat or whatever within the industry that there has been a loss of momentum in terms of international collaboration. Dodd-Frank has come in, different approaches. I mean, there's the UK's own regulatory changes. Some of them are compatible with what's happening in Europe. Some of them there's EU level. Some of them are much less so. So, I think there probably would always be a plea on behalf of the industry, not least because it is one of the most internationalized that there is, that there should be more coordination at international level. But as I know, the Commission certainly work immensely hard at this. It's not very easy, and I think it's got harder in the last few years.
All the things that have been said about risks of regulatory arbitrage within the EU apply 10 times larger at global level. And the global coordination is a subject that would require an entirely different panel. It's a huge subject. I mean, though if from my point of view, it can sometimes seem that international coordination is Brussels, Washington, as these are the only two cities in the world that matter. But we are talking intensely with the Americans. Let me give just one little example. G20 has a commitment that over-the-counter derivatives should be centrally cleared. Okay, so the US has legislation, we have legislation. over-the-counter derivatives have to be centrally cleared. That means via a central clearing counterparty, a CCP. Okay. What if a EU financial institution does an OTC derivatives trade with a US financial institution? That's no problem. We have legislation in place on both sides of the Atlantic saying that it has to be centrally cleared. Yes, but through which CCP? We have CCPs, they have CCPs. It can only be centrally cleared once. Clearing, you can't do double clearing. It has to be cleared once. Do we recognize their CCPs? Do they recognize our CCPs? Otherwise, the financial institutions will be scratching their heads. Well, both the EU obliges us to clear this transaction. The EU says it has to be through a CCP in the EU. The USA says it has to be through a CCP in the USA. So they cannot meet their obligations. So we need to talk about this. We need to talk about mutual recognition. And mutual recognition, we could talk about it for hours and hours. What does it mean? What are the criteria? And there's another aspect to, well, no, I don't even want to go there. But there's a question between the European Central Bank and the British government about whether Eurozone operations need to be cleared within the Eurozone or outside the Eurozone. There is litigation there. So, I mean, I won't talk about matters which are sub judice. There's litigation about that. So that's just one tiny example of something which requires international coordination, because we all agree that OTC derivatives operations have to be centrally cleared, but any institution anywhere in the world can click and trade with anybody anywhere else in the world. Where do they have to be centrally cleared? What are the acceptable CCPs? What are the non-acceptable CCPs? And then we need to talk about collateral requirements, which is another completely different subject. So we talk every day. And I must admit, we tend to take the rather arrogant approach in the EU that if we in Brussels, the EU, agrees with Washington, we agree that that the EU and the USA does this, and this, the rest of the world will fall into line. I mean, because together we have 80% of world financial markets. If we can agree on the details, like for central clearing, the rest of the world will fall into line. So we tend to talk to the Americans first. Other partners don't like that. The Japanese and Swiss don't like that. But we tend to try and work out a line with the Americans and then hope that that will have the force of impetus in the whole world.
Can I just add one point for those of you who don't know? The reason why the Commission has moved, and the Americans indeed have moved to insist on central clearing of over-the-counter derivatives is to ensure transparency, greater transparency, to try to deal with, prevent some of the difficulties that arose in the years preceding the financial crisis.
And also counterparty risk, because I mean this is a side issue. But when Lehman Brothers failed, there were quite a lot of derivatives operations that were frozen in midstream, and they're still trying to unwind them now. And if they had gone through a CCP, that wouldn't be the case. But there are very, very big derivatives operations for millions and millions that were just frozen before they had been terminated, and the liquidators are spending years and years trying to unwind those operations.
So I'm feeling the weight of history in this incredibly historic room, and I'm reflecting how remarkable it is that we had a massive crisis, and rather than increasing momentum to save ourselves from the money men, we seem to have gotten decreased momentum around regulatory progress. And it is remarkable that a huge crisis is not leading to greater coordination and more creative thinking about how to deal with the immense complexity of our financial markets now. I want to thank the audience for your patience